Something changed this week, not in the way headlines suggest, not with the drama social media wants you to feel, but in the quiet, structural way that experienced investors have learned to recognize. The latest jobs report came in worse than expected. Markets reacted. Gold and silver swung violently in both directions within hours. And if you're watching this, you're probably wondering what it means for your portfolio, your purchasing power, and the months ahead. Here's what I want you to understand right from the start. This isn't about predicting tomorrow's price. It's about recognizing a shift in the underlying conditions that drive long-term value in monetary metals. And whether you currently hold gold and silver, or you're considering entering these markets, the next 25 minutes will help you think through this moment with clarity instead of emotion. Let's start with what actually happened. The Bureau of Labor Statistics released employment data that missed expectations across multiple metrics. Non-farm payrolls came in significantly below forecast. The unemployment rate ticked higher. Wage growth slowed more than anticipated. Within minutes, gold spiked. Then it fell sharply. Then it recovered most of the loss. Silver moved even more dramatically, swinging through a range that would make most equity investors uncomfortable. If you checked your portfolio that morning, you might have felt confused. Wasn't bad economic news supposed to be good for gold? Isn't weakness in the labor market supposed to pressure the Federal Reserve toward rate cuts? Shouldn't that support precious metals? The answer is yes. But markets don't move in straight lines, and the initial reaction to any data release is often driven by algorithmic trading, positioning, and short-term speculation rather than fundamentals. What matters isn't the price action over a few hours. What matters is what this data tells us about the economic cycle we're entering and how that cycle historically affects monetary metals. Let me explain what this jobs report actually signals. For months, the Federal Reserve has been trying to engineer what they call a soft landing. The idea is simple. Raise interest rates enough to cool inflation without triggering a recession. Keep unemployment low while bringing price growth back to their 2% target. It's an admirable goal. It's also historically rare. This jobs report suggests the soft landing is becoming harder to achieve. When employment weakens faster than inflation cools, the Fed faces a dilemma. They can keep rates high to fight inflation and risk pushing the economy into recession, or they can cut rates to support employment and risk reigniting inflation. Neither choice is clean. Both have consequences for your purchasing power. And here's where gold and silver enter the picture. These metals don't perform well because the economy is strong or weak. They perform well when confidence in monetary policy and currency stability begins to erode. When the central bank's toolkit starts to look insufficient for the problems at hand, that's the environment we're entering, not tomorrow, not next week, but over the coming quarters. The biggest misunderstanding in precious metals markets is thinking these assets move based on economic strength. They don't. Gold and silver rise when people lose confidence in the alternatives, when bonds offer negative real yields, when currencies depreciate faster than official inflation statistics suggest, when government debt expands beyond what traditional fiscal discipline can contain. Right now, we have all three conditions developing simultaneously. The U.S. federal debt exceeds $36 trillion. Annual deficits continue to run above $1 trillion even during supposed economic expansion. The Congressional Budget Office projects debt service costs will soon exceed defense spending as the largest single budget item. Meanwhile, real yields on 10-year Treasury bonds remain barely positive after accounting for actual consumer price inflation. If you lend your money to the government for a decade, you're accepting virtually no compensation for inflation risk, default risk, or opportunity cost. And the dollar, despite remaining the world's reserve currency, has lost purchasing power consistently over the past 4 years. Groceries, energy, housing, and healthcare all cost significantly more than they did before the pandemic response spending began. This is the context that matters. Not one jobs report, not 1 month's price swing, but the structural reality that monetary metals tend to appreciate during periods of fiscal dominance and currency uncertainty. Let me take you back through history for perspective. In the 1970s, gold rose from $35 an ounce to over $800. Not because the economy collapsed, but because inflation accelerated. Real interest rates turned deeply negative and confidence in the dollar's purchasing power deteriorated. In the early 2000s, gold climbed from under $300 to nearly $2,000 by 2011. Not because unemployment spiked, but because central banks globally expanded their balance sheets, governments ran large deficits following the financial crisis, and investors sought alternatives to depreciating currencies. In both cases, the metals didn't move in a straight line. There were violent corrections, months where nothing happened, periods where mainstream analysts declared the rally over. But the underlying cycle continued until the fundamental drivers changed, until real interest rates rose sustainably positive, until fiscal discipline returned, until currency confidence stabilized. We're nowhere near those conditions today. Let's talk about the Federal Reserve's current dilemma with clear eyes. They raised interest rates aggressively over the past 2 years. That tightening has started to impact the real economy. Housing activity has slowed. Commercial real estate faces stress. Regional banks absorb significant losses on their bond portfolios. Credit conditions have tightened for businesses and consumers. But inflation, while lower than its peak, remains above the Fed's stated target. Core services inflation stays sticky. Shelter costs continue rising in official statistics. Wage growth, though moderating, still runs ahead of productivity gains in many sectors. This creates an impossible choice. Cut rates too soon and inflation could accelerate again. Wait too long and the economy could tip into recession, triggering job losses and financial instability. What does the Fed typically do when faced with impossible choices? They prioritize financial stability over price stability. They provide liquidity to prevent credit crises. They choose inflation over deflation when forced to decide. This tendency isn't unique to the current leadership. It's institutional. It's bipartisan. It reflects the political economy of central banking in a democracy with high debt levels. And it's exactly the environment where gold and silver have historically performed their role as monetary insurance. If you already own physical gold and silver, this is not the time to question your reasoning. Let me be direct about this. You didn't buy these metals to make a quick profit. You bought them because you understand monetary history, because you recognize that all fiat currencies eventually lose purchasing power, because you wanted an asset that central banks cannot print and governments cannot easily confiscate or devalue. That reasoning hasn't changed. If anything, it's become more relevant. The volatility you're seeing is normal. It's uncomfortable, but it's normal. Silver especially can swing 10 or 15% in a matter of days. That's the nature of a relatively small market with both monetary and industrial characteristics. What you should focus on is whether the fundamental case has weakened. Has government debt declined? Have central banks stopped expanding their balance sheets? Has fiscal discipline returned to major economies? Has trust in fiat currencies strengthened? The answer to all these questions is no. Your position in physical metals serves as insurance against monetary instability and purchasing power loss. Insurance doesn't pay off every day. Sometimes it costs you opportunity cost. But when the insured risk materializes, you're grateful you maintained coverage. The jobs report this week and the Fed's response over coming months will likely validate rather than undermine the reasons you hold these assets. If you don't currently own gold or silver and you're wondering whether now is the time to start, I want you to think carefully about your motivation. Are you reacting to price movements? Are you responding to fear of missing out? Or are you genuinely convinced that monetary metals deserve a place in your long-term portfolio based on understanding the economic cycle and monetary history? The answer to that question determines whether you'll be successful with this allocation. Precious metals are not growth stocks. They don't generate earnings. They don't pay dividends. They don't compound over time through reinvested cash flows. They sit in a vault or a safe deposit box, maintaining their purchasing power through periods when paper assets lose theirs. If you understand that role and accept it, then building a position methodically makes sense regardless of short-term price action. 5% of your investable assets. Maybe 10% if you're particularly concerned about monetary instability, acquired over time through dollar cost averaging rather than trying to time the exact bottom. But if you're looking to get rich quickly, if you're planning to leverage your position, if you're expecting metals to double in 6 months, you're setting yourself up for disappointment and poor decisions. The case for owning monetary metals is about probability and risk management over years, not certainty and profit over months. Let me address something that confuses many investors. Why does gold sometimes fall on bad economic news? Why does silver occasionally drop when inflation data comes in hot? The answer is market positioning and short-term psychology. Large institutional traders use precious metals as tactical positions within broader portfolio strategies. When economic data surprises to the downside, some traders assume the Fed will cut rates faster, strengthening the dollar in the short term as foreign capital flows toward higher U.S. yields. This can trigger selling in metals. Other traders might view weak employment as deflationary, causing them to reduce inflation hedges temporarily. Still, others might need to raise cash quickly to meet margin calls and other positions, selling liquid assets like gold futures to generate funds. None of this changes the long-term fundamental case. It's simply noise created by the mechanics of modern markets, where algorithms, leverage, and quarterly performance pressures dominate short-term price discovery. What experienced investors learn is to ignore this noise and focus on the underlying trends. Is government debt rising? Yes. Are real interest rates supportive of paper assets over the long term? Increasingly questionable. Are central banks globally accumulating gold reserves at the fastest pace in decades? Absolutely. These trends matter far more than what happened in the futures market between 9:30 and 10:15 on jobs report day. We need to talk about the elephant in the room that mainstream financial media consistently underplays. The United States federal government is running trillion-dollar deficits during economic expansion, not during crisis, not during recession, during growth. Think about what that means. In theory, governments run deficits during downturns to stimulate demand and support employment. They run surpluses during expansions to pay down debt and prepare for the next crisis. We're not following that model anymore. We haven't for years. Instead, both political parties agree on expanding spending. They disagree on what to spend on, but they agree that spending should increase. Tax revenues, even at current levels, cannot keep pace. The difference gets financed through bond issuance. Who buys all these bonds? Increasingly, not foreign central banks. Their treasury holdings have plateaued or declined in recent years. Instead, the Federal Reserve buys them during quantitative easing. Domestic institutions buy them, and yields rise to attract marginal buyers who demand higher compensation for duration risk and inflation risk. Higher yields mean higher debt service costs, which means larger deficits, which means more bonds to issue, which means even higher yields required to clear the market. Unless the Fed steps in to suppress yields through purchases, this is the cycle that concerns long-term oriented investors. It's not sustainable without either fiscal reform or monetary accommodation. Fiscal reform appears politically impossible, which leaves monetary accommodation as the path of least resistance. And monetary accommodation, when taken to extremes, undermines currency purchasing power, which is exactly when gold and silver perform their historical function. Let's get specific about real interest rates, because this is critical to understanding precious metals valuation. Real yield is simply the nominal interest rate minus inflation. If a 10-year Treasury bond pays 4% and inflation runs at 3%, the real yield is 1%. That's your actual return after accounting for purchasing power erosion. When real yields are high and rising, gold struggles. Why own an asset that pays nothing when you can earn a solid real return in bonds with no price volatility? But when real yields are low or negative, gold becomes attractive. You're not giving up much income, and you're gaining insurance against further currency depreciation and monetary instability. Right now, real yields are barely positive. The 10-year Treasury yields around 4.25%. Core inflation runs near 3%. That's roughly 1.25% real yield. Not terrible. But not compelling either, especially given the fiscal trajectory and the probability that the Fed will need to cut rates if employment weakens further. If the Fed cuts rates by 100 or 150 basis points over the next year, nominal yields will likely decline. If inflation remains sticky around 3%, real yields could easily turn negative again. That scenario has historically been extraordinarily bullish for precious metals. Not because of speculation, but because the opportunity cost of holding them essentially disappears while the insurance value increases. I want to address the dollar's role in all of this because it's often misunderstood. The dollar remains the world's reserve currency. Most international trade is still denominated in dollars. Foreign central banks still hold the majority of their reserves in dollar-denominated assets. This creates structural demand that supports the currency's value. But that doesn't mean the dollar can't lose purchasing power. It just means it might lose purchasing power more slowly than other major currencies. Think of it this way. If all major central banks are engaging in fiscal dominance and expanding their balance sheets, all major currencies can depreciate in real terms simultaneously. There's no contradiction. They can all lose value relative to real assets like commodities, real estate, and monetary metals, even while maintaining relatively stable exchange rates against each other. This is precisely what we've seen over the past 4 years. The dollar index, which measures the dollar against a basket of other currencies, has remained relatively range-bound. But the dollar's purchasing power for food, energy, housing, and healthcare has declined noticeably. Gold, priced in dollars, has risen significantly over this period. Not because the dollar collapsed, but because it depreciated in real terms while most investors focused on nominal exchange rates. This distinction is crucial. You don't need to predict a dollar crisis to justify holding monetary metals. You only need to recognize that purchasing power tends to erode during periods of fiscal dominance, and that metals historically preserve value during those periods. Let me be very clear about what you should not do in response to this environment. First, do not panic. Volatility in precious metals is normal, painful, but normal. If you're going to participate in these markets, you need to accept that prices will swing dramatically at times. Emotional reactions to volatility lead to terrible decisions, like selling at the bottom or buying at the top. Second, do not over-leverage. I cannot stress this enough. Using margin or leverage to amplify your exposure to gold and silver is an excellent way to destroy capital. These markets can move against you violently and quickly, triggering margin calls and forced liquidation at the worst possible time. Physical metals should be owned outright. Futures and options should only be used by experienced traders who understand the risks. Third, do not follow online hype without verification. Social media is filled with people making extraordinary claims about imminent price explosions, market manipulation, or insider information. Most of it is noise designed to generate engagement. Some of it is deliberately misleading. Your investment decisions should be based on fundamental analysis and risk management, not tweets from anonymous accounts. Fourth, do not ignore the rest of your portfolio. Precious metals are a component of diversification, not a substitute for it. You still need productive assets. You still need cash flow. You still need liquidity for emergencies. A well-constructed portfolio includes metals as insurance, not as the entirety of your holdings. Fifth, do not try to trade around short-term movements unless you have genuine expertise. The temptation to sell when metals rise and buy back when they fall is natural. But most investors who attempt this end up underperforming a simple buy and hold strategy. Transaction costs, taxes, and mistimed trades erode returns. And finally, do not make investment decisions based on price targets or predictions. No one knows where gold or silver will be in 6 months. Anyone who claims certainty is either fooling you or fooling themselves. What we can analyze is probability, risk, and historical precedent. Base your decisions on those factors, not on confident predictions. The best investors I've studied share a common characteristic. They don't try to predict the future. They prepare for a range of scenarios and position themselves to benefit from favorable outcomes while limiting damage from unfavorable ones. When it comes to monetary metals, that means understanding what could cause them to underperform and what could cause them to outperform. Gold and silver would likely struggle if we saw genuine fiscal reform that addressed deficit spending, if real interest rates rose sustainably to 3 or 4% through a combination of lower inflation and stable nominal rates, if productivity growth accelerated dramatically, making current debt levels manageable relative to economic output. These scenarios aren't impossible. They're just improbable, given current political incentives and economic structure. Conversely, metals would likely perform well if deficits continue expanding, if the Fed returns to significant balance sheet expansion to suppress yields or address financial stress, if inflation remains persistently above target despite rate cuts, or if geopolitical tensions accelerate the trend of central banks diversifying away from dollar reserves. These scenarios seem considerably more probable based on observable trends. Disciplined investors position for the higher probability scenario while acknowledging uncertainty. They don't bet everything on one outcome. They allocate thoughtfully, rebalance periodically, and adjust as new information emerges. That's the mindset you want to cultivate. Not fear, not greed, but careful probability assessment combined with emotional discipline. There's one trend I want to highlight because it often gets overlooked in retail investor discussions. Central banks globally have been accumulating gold at the fastest pace in decades, particularly central banks in emerging markets and energy-producing nations. China, Russia, India, Turkey, and others have significantly increased their official gold reserves. Why does this matter? Because central banks think in decades, not quarters. They're not trying to make a quick profit. They're managing sovereign reserves and thinking about what preserves value across complete economic cycles. When institutions with that time horizon and that level of expertise consistently accumulate an asset, it suggests they see long-term value that market participants focused on quarterly performance might miss. This doesn't mean retail investors should blindly follow central bank behavior, but it does provide a useful signal about how sophisticated long-term oriented institutions are thinking about monetary risk. If central banks are diversifying away from purely fiat reserve holdings and into monetary metals, that tells you something about their confidence in the current monetary system's stability over the next 20 or 30 years. One question I often receive is whether we're headed toward inflation or deflation. The assumption is that gold only works in an inflationary environment. That's not quite accurate. Gold can perform well in both inflationary and deflationary environments, depending on the policy response. In the 1930s, during the Great Depression, gold maintained value while most assets collapsed because governments devalued their currencies against gold to stimulate their economies. In the 1970s, gold soared during inflation because real yields turned deeply negative. What gold struggles with is stable purchasing power combined with attractive real yields and safe assets. When you can earn 3 or 4% above inflation in treasury bonds with no volatility, gold becomes less attractive by comparison. The question isn't whether we'll have inflation or deflation. The question is how central banks and governments will respond to whatever economic conditions emerge. And given the level of debt in the system, the political incentives, and the historical precedent, the most likely response involves monetary accommodation and currency depreciation rather than austerity and purchasing power preservation. That's the environment where monetary metals tend to fulfill their function, regardless of whether the immediate challenge looks more inflationary or deflationary. If there's one concept that separates successful precious metals investors from unsuccessful ones, it's time horizon. People who approach gold and silver with a 5 or 10-year perspective tend to do well. They accumulate positions gradually. They ignore short-term volatility. They focus on whether the fundamental case remains intact. They treat metals as insurance and wealth preservation rather than speculation. People who approach these markets with a 6-month perspective tend to get frustrated and make poor decisions. They buy after prices have already moved. They sell during corrections. They chase momentum. They expect consistent gains that metals simply don't provide. Your time horizon determines whether you'll succeed with this asset class. If you're thinking in quarters, you'll probably be disappointed. If you're thinking in years or decades, you'll likely find that metals perform exactly the function you acquired them for. This is patient capital. It's not trying to beat the market every month. It's trying to preserve purchasing power across complete economic cycles. That requires a different mindset than most modern investors are trained to adopt. But it's a mindset that has been validated repeatedly throughout monetary history. For those who are convinced that monetary metals deserve a place in their portfolio, but don't currently have meaningful exposure, let me suggest a methodical approach. Start by determining what percentage allocation makes sense for your situation. For most investors, somewhere between 5 and 15% of investable assets is reasonable. Not so much that volatility will cause sleepless nights. Not so little that it won't matter if the thesis plays out. Once you've determined your target allocation, build it over time rather than all at once. Maybe spread your purchases over 6 or 12 months. This accomplishes 2 things. First, it reduces the risk of entering at a temporary top. Second, it gives you time to become comfortable with the volatility and characteristics of these markets. Focus on physical metal first. Coins or bars from reputable dealers, stored securely. Exchange-traded funds can work for part of your allocation if you value liquidity, but understand the difference between owning paper claims and owning physical metal. Don't try to time the perfect entry. You won't. No one will. Focus instead on building your position at what you consider reasonable valuations relative to historical ranges and fundamental drivers. And once you've reached your target allocation, resist the urge to trade it actively. Rebalance periodically if metals grow to represent too large a portion of your portfolio. But otherwise, let the position work over time. This is not exciting. It's not going to generate content for social media posts, but it's the approach that historically works for investors who understand what they own and why they own it. Let me be honest about something that doesn't get discussed enough in precious metals investing. Holding through significant volatility is psychologically difficult. When you watch an asset decline 10 or 20% in a few weeks, every instinct tells you to sell and protect what remains. When you watch it rise 30% in a few months, every instinct tells you to take profits before it reverses. Both instincts are usually wrong in the context of long-term wealth preservation. The investors who succeed with monetary metals are those who have either experienced enough cycles to develop emotional discipline, or those who have thought through their thesis clearly enough that short-term price movements don't shake their conviction. How do you develop that discipline? By understanding what you own, by knowing the historical precedents, by recognizing that volatility is the price you pay for an asset that tends to preserve purchasing power when the monetary system comes under stress. It helps to avoid checking prices daily. It helps to focus on the fundamental drivers rather than the charts. It helps to remember that this is insurance, not speculation. But even with all that, there will be moments of doubt, moments when you question whether you made the right decision, moments when the mainstream financial media declares precious metals a foolish investment and everyone around you is making money in technology stocks. Those moments test your conviction. They separate investors who genuinely understand their portfolio construction from those who are following trends. If you can't hold through those moments, it's better to acknowledge that now and construct a portfolio that matches your psychological tolerance for volatility. Let's return to where we started, the jobs report that triggered this week's volatility. What it tells us, fundamentally, is that the economy is slowing in real terms, not collapsing, not entering obvious recession, but softening in ways that will likely force the Federal Reserve to cut interest rates sooner and more aggressively than many expected a few months ago. That shift from a tightening regime to an easing regime is significant for monetary metals. It changes the opportunity cost calculation, it changes the real yield environment, it changes the trajectory of currency depreciation. None of this happens overnight. Markets take time to price in regime changes. There will be volatility, there will be false starts and reversals, but the underlying trend is becoming clearer. We're transitioning from a period where the Fed fought inflation by raising rates to a period where they'll try to support the economy and financial system by cutting rates, even if inflation hasn't fully returned to their target. That's the environment where gold and silver have historically performed their wealth preservation function. Not because of speculation or hype, but because the alternatives become less attractive and the risks that metals insure against become more relevant. We live in an era of constant financial information. Every price tick is available in real time. Every analyst opinion gets amplified through social media. Every short-term movement triggers dozens of competing narratives about what it means. This creates an enormous challenge for investors trying to make sound long-term decisions. The noise drowns out the signal. The short-term obscures the long-term. The emotional overwhelms the analytical. Your task, if you want to invest successfully, is to develop the skill of separating signal from noise, to identify what actually matters from what merely feels urgent. Does a 5% swing in silver prices over 2 days matter? Not really, unless it indicates a fundamental change in supply, demand, or the monetary environment. Does a single jobs report matter? Only to the extent it confirms or contradicts larger trends in employment, inflation, and central bank policy. The signal right now is that we're in a late cycle economic environment with high debt, slowing growth, and central banks preparing to ease policy despite inflation remaining above target. That's a macro setup that historically favors monetary metals over the medium term. The noise is everything else: the daily price movements, the conflicting analyst opinions, the predictions about what the Fed will do at the next meeting, the headlines designed to generate clicks through fear or excitement. Learn to focus on the signal. Let the noise fade into the background. That's how you make decisions you'll be comfortable with, regardless of short-term volatility. I want to emphasize something that might seem obvious but is often ignored in practice. Your greatest asset as an investor isn't information, it's understanding. You can have access to every piece of economic data, every research report, every expert opinion, and still make poor decisions if you don't truly understand what you're looking at. Understanding comes from education, from studying monetary history, from reading about how cycles work, from learning about the mechanics of central banking and government finance, from understanding market psychology and your own behavioral tendencies. This takes time. It requires effort. It's not as immediately gratifying as watching your portfolio increase in value, but it's what allows you to maintain conviction during difficult periods and make rational decisions when everyone around you is reacting emotionally. If you're going to invest in precious metals, invest in your understanding first. Read the classic books on monetary history. Study the gold standard era and why it ended. Learn about what happened in the 1970s and why. Understand the 2008 financial crisis and the policy responses that followed. This knowledge base is what allows you to evaluate current conditions without simply reacting to headlines. It's what allows you to recognize patterns that repeat across different eras. It's what gives you confidence in your decisions. Education is the foundation. Everything else builds on it. As we approach the conclusion, I want to leave you with a framework for thinking about the months ahead. We cannot predict with certainty what will happen to gold and silver prices. We cannot know exactly when or how aggressively the Fed will cut rates. We cannot foresee every economic variable that will influence markets. But we can observe trends. We can assess probabilities. We can prepare for likely scenarios while acknowledging uncertainty. The trends suggest we're entering a period where monetary metals become more relevant, not less, where the insurance they provide becomes more valuable, not less, where the alternatives they offer to purely fiat holdings become more attractive, not less. That doesn't mean prices will rise in a straight line. It doesn't mean you'll see immediate vindication if you hold or buy these metals. It means the fundamental case is strengthening, and patient investors who understand that case are likely to be rewarded over time. Approach this environment with humility about what you don't know, but also with confidence in what you do know. You know that debt continues expanding. You know that central banks face difficult trade-offs. You know that monetary history provides clear lessons about what happens when governments prioritize short-term stability over long-term currency soundness. These things you know. Everything else is probability and risk management. We've covered a lot of ground in the past 25 minutes, from the immediate market reaction to the jobs report, through the deeper macroeconomic forces at work, to practical guidance for both current holders and prospective investors. If you take nothing else from this discussion, take this. Your success with precious metals will be determined more by your emotional discipline and depth of understanding than by your timing or trading skill. The investors who do well in this space are those who acquire positions for sound fundamental reasons, who maintain those positions through volatility, who avoid overleveraging and emotional decision-making, and who focus on the long-term preservation of purchasing power rather than short-term profits. That approach won't make you rich overnight. It won't give you exciting stories to share at dinner parties. But it will likely preserve and gradually grow your wealth across a complete economic cycle in ways that purely fiat holdings may struggle to match. The crisis that some speak of isn't necessarily a collapse. It's a slow-motion erosion of purchasing power and confidence in monetary stability that plays out over years, not days. Monetary metals exist to help you navigate that environment successfully. Whether you're a current holder, reassessing your position, or someone considering entry for the first time, let your decisions be guided by education, probability, and discipline. Not by fear, not by greed, not by the noise that surrounds these markets daily. The path forward requires patience. It requires continuous learning. It requires emotional control when volatility inevitably strikes. But for those willing to cultivate these qualities, precious metals can serve their intended purpose as wealth preservation and monetary insurance. Stay informed, stay disciplined, stay thoughtful. The markets will continue to swing. The headlines will continue to generate drama. But underneath all that noise, The fundamental forces that drive long-term value in monetary metals continue to develop in ways that thoughtful investors can recognize and prepare for. That preparation, more than any single trade or timing decision, is what positions you for success across complete economic cycles. Thank you for your time and attention. Until next time.